Macro hedge fund manager warns of 1970s style stagflation. So I've done a range of videos over the last month warning about high inflation leading to both a market crash and an economic collapse. So I did this video, market crash and economic collapse. I did this video where billionaire Carl Icahn was warning of a recession, if not a depression. And our, well, I was going to say most hated, maybe he's not the most hated, but anyway, BlackRock inflation warning. The global hyperinflation depression. And now we've got a warning from one of the best macro hedge fund managers in the business. And Julian Brigden tweeted this out: when one of the best macro shops in the business says this, you should pay attention. So we're paying attention. So let's have a look at this. Brevin Howard sees rising risk of it 1970s style inflation shock. The hedge fund firm says the Fed is behind the curve. The firm's $8.5 billion flagship fund returned 6.6% in March. So let's have a look at this article by Nish Kumar. Global price rises risk turning into 1970s style inflation shock, which eventually led to recession and high unemployment, according to hedge fund giant Brevin Howard Asset Management. The macro trading firm, which is off to one of its best gains in nearly 2 decades of trading, said the current macro environment is as complicated as at any time during the last 75 years, according to its annual outlook. This combination of high inflation, tight labour markets, and uncertain inflation expectations introduces a prospect of a 1970s style wage price spiral, which proved very costly to reverse during the Volcker era, according to the note to shareholders of a listed fund which it manages. Brevin Howard, one of the best-known macro hedge fund firms with about $19 billion in assets, invoked a period of crippling inflation decades ago when former Federal Reserve Chairman Paul Volcker delivered the so-called Saturday Night Special, a radical and unexpected tightening of monetary policy on an October weekend in 1979. Volcker's tightening of monetary policy led to a recession and high unemployment, but ultimately reigned in spiraling inflation. Right now, the Fed is significantly behind the curve in raising rates, which should be between 4 and 6% based on traditional approaches to monetary policy, the firm said in a rare comment on the market outlook, adding that both risk assets and fixed income tend to underperform in such an environment. Brevin Howard echoes comments from veterans such as Man Group's PLC's Chief Executive Luke Ellis and Henry Kaufman, who have flagged the risks of spiraling inflation and questioned whether the Fed will do enough to combat it. So this is something that you guys that follow this channel, I've been predicting really since I started this channel in 2020, that we would have an inflation problem. And that's how did I know? Well, I have to be honest and put it down to Austrian economics. And remember back in the 1920s, 1928-29, Ludwig von Mises said that we were about to have a big crash when everyone was saying, no, this is now permanently, markets are going to be permanently high and continuing to rise. And even Keynes said, no, market's all good, she's all sweet. And what happened in 1929? Well, same thing here. Austrian economics has been predicting this. And you know what? Paul Volcker in 2010, well, he admitted something about Austrian economics.
My question's in regard to economics and the Austrian School of Economics. I mean, nobody really paid that much attention, and now suddenly the crisis seems to vindicate, the role of the Fed in terms of manipulating or altering the incentives in the economy. I'm just wondering if there may be a return to that school.
Well, the School of Austrian Economics, I learned about that, I'm trying to think, 62 years ago, I think. 62 years.
Now you're telling everybody how old you are. He's slightly over 80.
They have some insights that maybe we have forgotten about. Some of the old scholars of the so-called Austrian School. I literally took my first course in economic theory from an Austrian, who was of the Austrian School. But the idea of credit creation being important for one symptom of what was going on has certainly been vindicated, I think. If you look at the statistics in the United States particularly, I think to some extent this would be true in Europe, but it began back when I was chairman of the Federal Reserve. Just at the beginning, the amount of credit in the American economy relative to the GNP has just skyrocketed. I think it used to be more or less the same, and now the amount of credit outstanding is 3 times the GNP, if I remember the figures roughly. And that is reflected in the leverage of the financial firms and the investment banks that have failed, and in commercial banks to some extent, that they all built up the balance sheet on the liability and asset side because of a sense of easy credit and no problems. And that's what's come home to roost. So suddenly they haven't got enough capital to support the credit, which wouldn't surprise most Austrian economists, I suspect.
And now we've got some Austrian economists who are warning, actually, that the last couple of years of just really easy credit, easy monetary conditions from central banks has created asset bubbles. Don't think you can argue with that. Very similar to the 1920s, the late 1920s. And that now we've got inflation and central banks are raising rates, and it's a matter of debate as to how high they do hike them. That we will see rising interest rates prick the debt bubble and asset prices collapse like 1929. There's some out there that are warning that, and I certainly don't rule that out. But I suspect that central banks, as soon as that happens, will, aka the Powell pivot, will reverse course, go back to quantitative easing to support markets. That's my base case. However, people are talking about, go down rabbit holes like the Great Reset and say, well, no, you know what? It's like Princes of the Yen. Just get everyone into a bucket load of debt. Everyone speculate, drive rates up, and just kill assets. And then we have the powers that be that will come in and say, well, you'll own nothing, you'll be happy. We'll take off your debts and your mortgage for you. You just hand over the keys, kind of thing. Anyway, whatever way it works out, we don't know, but they're what some of the suggestions out there. Now, this was a very interesting chart from Andreas Larsen. If wage growth is a guide, then the Fed could go way above neutral rates. So, wow, 8%. And this is the warning that Brevin Howard was talking about. Wage spirals getting out of control, meaning central banks are going to have to raise rates a lot higher than we first expected. And this is a very interesting chart that just goes along with this potential wage spiral, outlook. So here in Australia, we got job vacancies. I haven't seen job vacancies like this before. So total job vacancies of 423,500 equates to 3% of the labour force. And if you look at this chart, well, it looks like our unemployment rate is going to be heading towards, half-century lows. So we're going to have record low unemployment, and demand for labour is rising. and the cost for labour is rising. So watch this space. So here in Australia, the market is pricing in 12 RBA hikes over the next 14 meetings to where the cash rate will be 3% in August next year. And then the market implies that the mortgage rate will be a tad over 6.4% in 2023. However, that's not quite right. No one really pays those standard variable rates. And if you are, well, you're getting ripped off. If the cash rate does go to 3% in August next year, then we're looking at mortgage variable rates at around 5 to 5.5%, definitely in the 5% mark. And that is going to have a pretty big impact on especially first home buyers that bought in the last couple of years, especially those ones that had no deposit. They took funds out of their retirement accounts. They took government grants, both state government and federal government grants to buy a new home, maxed out their borrowing capacity at record low interest rates. A lot of them fixed for 3 or 4 years at 1.89, 1.99. Well, they'll be rolling off onto 5.5%. So that's going to be very interesting to see how that plays out. And how will the government once again intervene in the market to prop it up? So lenders at the moment have been raising all their fixed rates from 1 to 5 years. In Australia, that's predominantly what we have, 1 to 5 years. There's a few banks that will offer 7 and 10 year fixed rates, but we don't have the 30-year fixed rates like in America. But lenders have been slashing their variable rates and boosting perks as housing demand slows. And housing credit impulse looks like it is rolled over significantly and is heading down, albeit off a high watermark. However, change in capital city dwelling prices tends to follow. So watch this space, and you can see back in 2018, leading up to the last federal election, what happened with housing credit impulse. And we saw housing fall 10 and 12% respectively in a 12-month period in our two major markets, Sydney and Melbourne. So we are seeing house prices cool off now. People are starting to factor in rising interest rates and what that means for household budgets. So if we're going to have a 1970s style stagflationary environment again, so how should we invest? Well, we should probably go back and study what asset classes performed well in the 1970s and maybe try and replicate that. Well, I've already done a video. I did this video a couple of weeks ago, $125 to $714 silver, where we did this comparison that if the 1970s plays out again and we see similar moves in the silver market like it did in the 1970s, well, we're looking at somewhere between $125 and $714 silver. So I highly recommend you guys watch this video if you haven't yet watched it, because if we are, and I think it's very likely that we are moving into a stagflationary environment, learning about the 1970s and the moves in especially precious metals during the 1970s might be worth our time. I'll put a link in the description below to this video. And I'll finish up with this from Ronnie Stoffele, an Austrian investor, Austrian economic investor. Isn't it encouraging that gold has not really suffered from the current surge in bond yields? My honest opinion, that's an impressive sign of strength. And he shares this chart down below. And I wanted to finish off with this because in our next video, we're going to have a look at Ronnie's preview to his 2022 In Gold We Trust report chart deck. There's some very fascinating charts in there on gold and silver, which we'll discuss in another video. Anyway, guys, love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. We really do appreciate it. If you haven't yet subscribed, do so and hit that notification bell. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.